Mortgage rates continue to tick down as jobs data comes in weaker than expected. Now, this may lead some of you to think, wow, jobs data is weak, the economy is weak, we are bound to experience a housing market crash. After all, the housing market is already shifted from what used to be a seller's market into more of a balanced market pretty much throughout the country. And yes, some counties are experiencing a buyer's market right now as we speak. We're going to talk about what is going on in the overall housing market, what's happening with the jobs data, and why mortgage rates are dropping. They're at the lowest levels that I've seen in the past 18 months or so. But no, I do not think we're going to experience a housing market crash. And I think the best way for you to think about it is look, the housing market still has stimulus working through it and is going to have government stimulus working through it for the next 30 years or so. That's because back when the government printed money, when the Federal Reserve printed money, gave out stimulus checks during the COVID pandemic, that obviously fueled inflation and gave Americans a good amount of stimulus to spend into the economy. It stimulated the economy. Well, the housing market has its own form of stimulus in the form of low mortgage rates. Many of the homeowners out there right now are still have that stimulus from the pandemic. They still have 3% mortgages, 4% mortgages, 2.75% mortgages, and their payments are so affordable that they are going to do everything they can to hold on to those mortgage payments. So, we're going to talk about that. And that's my primary reason why I don't believe a housing crash is coming within the next year or two, is because there's too much stimulus in the housing market from homeowners out there right now. So let's get into it. Before we do, my name is Liam O'Reilly. I'm a realtor with Jerry Riley Real Estate here in Vermont. If you have any real estate needs, whether in Vermont or anywhere else, reach out to me directly. All of my contact information is in the description. So these jobs numbers that just came out today, US jobs reports shows hiring has shifted into a lower gear. And I think this chart really sums it up great, where we see back when the government was stimulating the economy coming out of the COVID pandemic, we saw jobs were increasing rapidly. People were hiring all over the place. And now we can see a clear downward trend in jobs added into the economy. Now, the past few jobs reports that have come out in 2024 have all been revised downward. We're going to talk about that later in this video, but what that means is that this $142,000 number is likely high. Last month's job data was revised lower. The month before that was revised lower. January was revised lower. So it's very likely that this jobs number is higher than what it actually is, indicating that the Federal Reserve is going to cut rates. Now, the question is, how far are they going to cut? We've already seen mortgage rates drop. If we take a look at New England Federal Credit Union, this is a local bank here in Vermont that shows their mortgage rates online. The best rate you can get with New England Federal Credit Union right now for a 30-year fixed rate mortgage is 5.875%. We haven't seen rates below 6% since spring of 2023. So about 18 months since we've seen rates dip below 6%. Remember, this time last year, rates were at almost 8%. So a big change in rates, and we're likely to see it shift lower. Now, we could see rates dip below where they are now, dip down to that 5.5% range. They might not go all the way down there until later on this year, but we could see them dip to maybe 5.75, 5.625, somewhere in that range within the next month or so if the Federal Reserve drops their Fed funds rate by 50 basis points as opposed to 25 basis points. And that's because right now the market is pricing in a rate cut of around between 25 and 50 basis points. It's either going to be one or the other. For the past few months, or at least for the past month or so, the market has priced in a 25 basis point cut from the Federal Reserve in September. Now, with weaker data coming out about the economy, the fact that we're likely entering into a recession if we haven't already entered into one is pushing the market to consider a 50 basis point cut. That's why we saw mortgage rates drop below 6%. Now, if the Federal Reserve actually acts on that 50 basis point cut, I think we will see mortgage rates come down even further. That's because right now there's uncertainty with what the Federal Reserve is going to do. Usually, with the past few Fed meetings, we've known exactly what the Federal Reserve is going to do. They were either going to keep their rates steady or they were hiking for the past few years or so. Now they're going to cut. We know they're going to cut later this month. We just don't know if it's going to be 25 basis points or 50 basis points. And if we see a 50 basis point cut, I think we're going to see mortgage rates immediately start to drop lower than where they are today. So getting back into this jobs data. So we see here, this is what I was talking about in regards to revisions to the job numbers. June and July were revised down by a combined 86,000 jobs, bringing the 3-month average to 116,000 jobs. Over the year before last month, employers added an average of 202,000 jobs per month. So the amount of jobs being added into the economy is declining drastically. And this impacts you as a home buyer or a home seller because this is going to affect mortgage rates and it's going to affect how many people out there can afford to purchase property right now. So as we continue to scroll down, we see here the unemployment rate right at the top dropped to 4.2% after rising to 4.3% in July. So virtually unchanged unemployment rate. When we take a look at some other indicators in the economy, we see that a broader measure of underemployment includes those people working part-time who would rather be working full-time, ticked up to 7.9% in August, the highest level since October of 2021. So the highest level in almost 3 years of people who want to be working full-time but can't find full-time work and are working part-time, right? That's not a strong sign for the economy. These are all signals to the Federal Reserve that, hey, it's time to cut, and it might be time to cut by 50 basis points. Sector growth has narrowed even more. Industries adding significant jobs were healthcare and social assistance, but manufacturing down here at the bottom has not been so resilient and shed 24,000 jobs. So less jobs in manufacturing. And you look at the industries that are adding people, that are adding employees, food and drink establishments, construction, which has remained surprisingly resilient in the face of high interest rates, which is a little bit surprising because there should be less building going on. There are less housing starts, but there's a good amount of housing backlogs in the economy. But food and drink establishments and construction jobs are not known for being the highest paying jobs out there. I bet that some of the people being hired by these construction companies, by these restaurants, are people that used to have maybe higher paying jobs and were laid off, forced to find work either in construction or in restaurants. Now, I wanted to scroll down here to what the Federal Reserve is thinking. Chris Waller, a Fed governor, gave a speech today with a little something for everyone. He avoided clearly committing to a big rate cut in September, but he did say that cooling data requires action and that he's open to front-loading rate cuts if appropriate. And he's open-minded about the size and pace of rate cuts, right? They're considering front-loading rate cuts, meaning they're considering dropping by 50 basis points here in September. Now, one last thing I wanted to mention is talking about the downward revision and why these revisions are so high. This person right here out of the New York Times, downward revisions could be a warning sign. And he says here, the recent pattern of downward revisions could be a bad sign, however. When the economy is at a turning point, headed into a recession or beginning to emerge from one, the statistical assumptions that are used to fill in the blanks can be wrong. He mentions up here that not everybody, they use these job numbers based off of surveys, right? So businesses submit surveys talking about how many jobs they've added, talking about how many layoffs they've had, and that's how the US government comes up with their jobs numbers. But not everybody completes the survey on time. So some people take longer than others to complete the survey. So the data can be lagging a little bit. And so to make up for that lagging data, the government makes assumptions about what their answers would be. But it says here, when the economy is at a turning point, headed into a recession, or beginning to emerge from one, the statistical assumptions that are used to fill in the blanks can be wrong, to fill in that missing data that isn't in yet. Ordinarily, for example, if a business doesn't respond to the survey, that probably means that somebody forgot to submit the data. In a recession, such a failure to respond might mean that business has closed, right? So the assumptions that the government is using to come up with this $142,000 number could be wrong, and they have been wrong for months now. So we're likely to see another downward revision because the economy overall is not in a great place. And when we take a look here, last month, the Labor Department released a preliminary version of that revision, which showed that there were 818 fewer jobs in March than previously reported. 818,000 fewer jobs in March than previously reported. Now, I believe that was the year over year data. So the 12 months ending in March, they reported 818,000 more jobs that were added to the economy than actually were. But still, that revision has been going on for a while now. And it's not a good sign for the overall economy. So, what does this mean for the housing market, right? This is a housing channel. Now, layoffs and bad job numbers are not good for the overall economy, right? That will mean that there's less home buyers out there and there might be more sellers because people might sell to find work in other parts of the country or might struggle to pay their mortgage payments on time and be forced to sell. That being said, like I mentioned at the beginning of this video, I think the best way to think about where the housing market is the housing market is still stimulated. And the reason why it's stimulated is because people have locked into 30-year mortgages to 15-year mortgages at rates that were stimulated by the Federal Reserve and by the federal government at low interest rates. That stimulus is still affecting housing today. When we take a look at mortgage payments if we take a look at where the median sales price was, the median sales price, I'm using 350,000. So a $350,000 median sales price. This was where the median sales price was in 2022, 350,000. Right now it's closer to 400,000. We see here that the total mortgage payment, including principal, interest, property taxes, and homeowners insurance, would be about $1,600 per month for the homeowner who bought that median price property at a 3% interest rate in 2022 or earlier, right? So they're not going to want to give up that $1,600 monthly payment, especially when their only other option, if they were to sell, is to buy a property right now that's more expensive and at a higher interest rate, which will have a higher monthly payment, or to rent. For the average rent across the United States is $2,054 per month. So people are going to do everything they can to stay in their homes to keep that low mortgage rate, which is why we aren't seeing many properties hit the market. Yes, inventory has increased, but that's because buyers aren't out there. Interest rates are high. They're too high for the people who can afford to get a mortgage right now. And with worse jobs data, with the economy in a worse place, with savings in a worse place, there are less people out there who can purchase properties. Now, as we move into the future here and as rates begin to drop, I think this could go one of two ways, right? If enough people lose their jobs, we could see slower demand for housing, right? If people don't have jobs, they won't be able to get mortgages. They won't be able to purchase properties. It doesn't matter how low interest rates are. If you don't have a monthly payment, if you don't have monthly income, you're not going to be able to get a loan to buy a property. So that's one scenario. If we enter into a massive recession, is we could see demand continue to weaken. That being said, what I think is more likely is that we're going to see interest rates start to fall, and the lower that interest rates go, the more buyers will jump into the housing market. If we just take a look at affordability as interest rates drop, so we take a look at the median sales price, which is around 400,000 right now. I know it's a little bit below there, but if we take a look at 400,000 and we take a look, we're using a 20% down payment, and we take a look at 6%, which is where rates are right now. The total monthly payment for a 6% mortgage at 400,000 is $2,453 per month. If we drop that down to 5%, we're at $2,200 per month. So about a $200 monthly payment difference between a 6% mortgage and a 5% mortgage. So that's pretty significant for some people. When we drop it down to 4%, again, another $200 off that monthly payment, which is going to bring more homeowners into the housing market or more buyers into the housing market once monthly, especially if rates end up dropping to around 4%. Now, I don't think they're going to go that low this year. There's a chance that they go that low next year, although I don't think it's likely unless we're in a massive recession, but that'd be right around where the median rent is. So anyway, I hope you guys enjoyed this video. I hope you learned something from it. Leave me a comment. Let me know what you think about this jobs data. What do you think will happen to the U.S. economy as we move through 2024 and into 2025? I love to know your thoughts. Thank you for watching. I'll see you in the next video.